looks like for your outlook, you're kind of broadly optimistic about everything bar the US. Why?
Well, I think let's just be honest about the US situation first. It's not. I'm not a pessimist on the US. Actually, I was not in the camp arguing for a recession in April when we had the Liberation Day. It's just after nearly 3% annualized growth for the best part of 2 years, slowing to a little bit below 2% is significant weakness. I mean, my view at the moment, the series of reports I've sent out, I've called it the art of muddling through, which I think actually is roughly right. We've got a very significant shock to global demand and supply coming from US trade policy. This is anti-growth and at least increases the risks of US inflation. We have two very significant geopolitical events ongoing, Israel-Palestine and Russia-Ukraine, with commensurate disruptions to global demand and supply. There's a great degree of policy uncertainty around advanced economies and China when it comes to fiscal. We're in the UK and we highlight the issues in the UK gilt market and worries about fiscal policy, but actually you can throw the US in there with its fiscal problems, France, Germany, Japan. We all have fiscal challenges. No one across the advanced world is properly addressing the long-term challenges coming from an aging population at a time when deficits and debt are elevated. And you put all of this together, so this is pretty tough. But then when you actually look at the economic data, what you see is actually a story which is global trade and industrial production look set to gradually expand over the next couple of years. US GDP in the last print was revised up. Japanese GDP, UK GDP, surprise to the upside in Q2. Actually, economies are withstanding these shocks. The mood is quite bad, but the facts on the ground are actually consistent with just okay growth. We're muddling through, we're complaining about it a little bit, but actually the risk of things going very badly wrong seems to be fairly low.
Yeah, but muddling through is a term that we're so familiar with in the UK. It's just kind of extraordinary to apply it to the US. And also, I think, how reliable, for example, is the non-farm payroll data that's coming on Friday, as we got that big shock revision recently of NFP data.
Yep.
And also that there are such significant challenges to so many institutions from the Trump administration trying to reshape, the global economy and the US economy.
Okay, so we have to distinguish between two things here, which is the cyclical and the structural consequences. So in markets, I think my view would be the market overestimated the cyclical downside risks of the Trump administration's policies, especially in April. And probably, at least in the first instance, underestimated the long-term consequences for supply potential. We've been here before. I'm sorry to just bring Brexit up, but on the day the UK voted to leave the EU, the consensus was the UK would fall into recession in the second half of 2016, which didn't happen. No one would have made the case that, say, UK-focused funds would have had 10 years of outflows. That's roughly what we see now in the US, where if you would have asked people in April with the Liberation Day tariffs, what's more likely by the middle of the year? The US is in recession or the dollar's depreciated by 15% and we'd be worried about long-term institutional strength in America. You say, well, US recession, the dollar's probably going to go through the roof and we can just forget about some of these issues. Actually, that's exactly what we're seeing play out now. We're being surprised with the cyclical strength in America, but we're starting to understand actually what are the long-term consequences of all of this. And I think that's actually where currency markets are the best read on the way people are thinking about some of these issues.
And isn't that so interesting that we were worried for a long time after Brexit, and Europeans were worried that maybe Brexit would be a blueprint for other European countries, and guess what? Maybe it's something that we are now applying to the US. I think that's very interesting. In terms of what you're expecting then for the Federal Reserve and interest rate, again, it's a kind of 2026 question. How dovish does the Fed go?
I think we'll get...
And is there an inflationary shock coming next year?
So the Fed, I think it's just worth keeping in mind, is a dual mandate central bank. The Bank of England, the ECB, the BOJ is squarely focused on inflation. With the Fed, it's inflation and employment, which means the Fed over summer, and I'm looking backwards here, has constantly been thinking, are we getting further away from our inflation mandate with these tariffs, or are we getting further away from our employment mandate with these tariffs? And that dictates where you move on policy. in all likelihood, based on the evidence, the labour market costs seem to be larger than the inflation costs. So we're going to have a bit more inflation, maybe a three-handle for a while, but actually it's the risk of the labour market which now seem more pronounced. And so the trade-offs now incentivise the Fed actually to start cutting rates. I think we probably get a cut in September, then let's see what happens. I think most of the cuts will come into next year. The problem with this is, and this is one of the strange ironies with the Trump administration, clearly the administration wants the Fed to cut interest rates. The way a central bank cuts interest rates when faced with inflation risks is for markets to be absolutely convinced that in the end the inflation target will be hit by the central bank. So the way to get the Fed to cut is for Trump actually to say, Powell's the best central banker in the world, I've never met such a genius in all my life, he's definitely going to get inflation back to 2% no matter what happens. Strengthen the credibility of the Fed so that they can start cutting interest rates when inflation is high. In fact, actually, the moves undermine the Fed, the criticism of Powell, the criticism of the way Fed policy has been set. And that actually reduces the scope for the Fed to cut interest rates as inflation is above target.
Yes, I mean, one could counter unless President Trump does do what he wants to do and has said that he wants to do, which is to sort of stack the Fed board, and then the narrative but anyway, that's all speculation.
But that comes after, right? I mean, that comes after. Like in the immediate instance, if you really want the Fed to cut interest rates a lot today, the way to do it is to strengthen the Fed.
Yeah. Let's turn to the UK.
Please.
Even over the summer, huge amounts of speculation about what the Labour government is going to do in the autumn budget. Is it a windfall tax on banks, a wealth tax, i.e. housing? Is it about pensions? How do you see the pressures on the government's budget?
So there's a big gap in the case of the UK between the general narrative and the facts on the ground in two respects. First, when it comes to the underlying economy, and second, when it comes to the scale of the government's problems. 50 billion in tax increases, 1976 style IMF bailout, massive black holes, all of this is just fun to read, but is not consistent with the problems the government is facing. Much more likely, and I think your Economist did a great job as always at calculating this kind of stuff, probably 20 billion is probably around what the government will have to raise. This is a 3 trillion economy. That's not a huge amount in the grand scheme of things. It's worth also keeping about borrowing so far this fiscal year is exactly in line with the OBR's estimates. The OBR will have to revise up its forecast for this year. It had a 1% in March. Probably we're closer to 1.4, maybe even 1.5. And borrowing costs at the 10-year horizon are roughly where they were in March, with the last forecast higher, admittedly, at the 30-year, but not by a huge amount. And so when you start actually doing the maths, you say you probably need to find probably 15, 20 billion. You'll get that from, I think, two places. One would be by freezing the income tax thresholds. I wouldn't be surprised actually if they put fuel duty up this time. I think that probably makes sense. And then you say, what other taxes can you raise? The challenge is the government, unfortunately, has lost so much credibility. It's lost control of the economic narrative that any tax increases now will be negative for confidence, and it's amplified by the fact that the government has painted itself into a corner by not properly addressing the welfare spending and the incentives around welfare in June, and well, that's close to half of the budget. And then the other half of the budget is stuff you really don't want to touch, like education and healthcare and defence. And then 2/3 of the tax base, which is income tax, VAT, and employee national insurance. So we're not going to raise those taxes. And so you're really limited. You have to look at small pools of tax and potentially large increases, which is why the headlines look so scary. Because if you start to dramatically increase taxes on things like wealth and other things, you really disturb incentives in the real economy. Okay, that all said, just look at the data for a second. Annualized growth in the first half of the year, 2.2%. Consumer confidence, a little bit below long run average, not a huge amount. PMI's at 53. Business confidence up, according to the Lloyd's survey. Right, this is not an economy which is stagnating or flatlining, but the mood is dire. We have self-esteem issues. Households are reluctant to spend. It's not that they lack the cash.
Just very briefly, I've only got 30 seconds.
Sorry.
Do you think there's going to be any taxes on business? Because that's the most important thing for business.
I think there's a significant risk that there's an increase in business taxes, yes, just because of the political trade-offs facing Labour.